We're going to start with the This Week part of our show. And this is where I like to talk about what I believe is important for individual investors to consider over the next 5 to 10 business days before they make their investment decisions. I'm going to talk about economic data. This is probably the most important part of this segment. We're going to talk a bit about what we've seen recently with regards to inflation data, what we're going to see with respect to other economic data, GDP, housing, consumer spending, consumer sentiment. These are all going to play a factor in how the market behaves or reacts over the next 5 to 10 business days and beyond. We're going to also talk a bit about, has the market already factored in the current interest rate hikes that we've seen so far and the potential rate hikes that we could see down the road? The United States is about to raise rates again this month. We've already seen Bank of Canada raise rates. What do we predict or project they're going to do? And has the market already factored in this rate increase? And lastly, price of oil. Price of oil continues to be important. We've been hearing time and time again how the Europeans are struggling as the Russians stop the flow of natural gas and oil to the European area. And really, the sanctions that have been put on by the West in general on Russia. And now they've turned around and said, well, if you're going to put sanctions on us, we're not going to allow for natural gas to flow to places like Germany. So how is that going to play out over the coming months as we get into the fall and winter season when the temperatures fall and you need natural gas to heat homes, to heat businesses, to produce goods? And so the price of oil is definitely important, and we're going to touch on that as well. So without further ado, let's start with the first topic, economic data. And I think we have a couple of charts we can put up regarding the economic data. It's been crucial as we've seen the markets react substantially to it. Here you can see how the markets have been on a pretty significant slide, high inflation readings that we've seen, and you've seen the markets really tail off. They've come back a little bit towards the end of that chart over the last week or so, but unfortunately, the gains of this past week have been taken away from us as of yesterday, when I guess we saw a bit higher or a bit hotter inflationary data out of the US. We saw inflation fall to 8.3%. We were expecting or hoping for an 8% reading. I was actually hoping to see a number that starts with a 7. I think that would be great. But because we got a little bit hotter inflationary data out of the US, we saw a tremendous pullback in the markets yesterday. As I said earlier, the 7th largest pullback we've seen for the markets ever in the US. And as we move forward, we're going to see, or we're going to hear the Fed speak in the next week or two about their interest rate hikes that they're going to put through. It looks like a 75 basis point hike is in the cards, but many are now calling for a full percentage point. We're also going to get data on GDP and growth in general. As interest rates move higher to combat inflation, what does that mean for GDP? And I think it's very important for individual investors to look at this economic data as it comes in to assess. And we know good economic data usually means it's bad for the market, and bad economic data actually means some good things for the market. I think we have another chart to show here regarding some economic data. So here you can see inflation data. As you see, the inflation numbers have really spiked higher as we moved into 2022. You can see a bit of a pullback on the blue line, and that is inflation in general. But when you strip out and you look at core inflation, which strips out very volatile energy prices and food prices, you can see core inflation really hasn't fallen much. So inflation is still a very important for the Fed. Obviously, that's what they're basing their interest rate policy on. And as we move forward, all the other economic data will be as very important to see what path the Fed will take in raising interest rates. The second topic that I think is important for individual investors to consider as they make their investment decisions is, has all of these interest rate hikes, have they already been factored in? And I think we have a chart on the market, and we can see once we put that chart up that the market actually is starting to make higher lows. And what I mean by that is, you can see it here. If you look at the low that we saw mid-June. That was kind of the low point for the market. The S&P 500 was in and around 3,600 points. Again, I use the S&P 500 because it is the largest index in North America, a lot larger, obviously, than the TSX, Toronto Stock Exchange up here, or the Dow, or even the NASDAQ. So I always like the S&P, and that's what a lot of us money managers look at. And if you notice, it pretty much a pretty steep rise from mid-June till about, let's say August, probably mid-August. And then we saw a decline from mid-August. We saw a bit of an uptrend in September. And now, as of yesterday, gave back most of the gains there. But I guess what I'm looking at, and what a lot of traders are looking at are we starting to make higher lows? So if we saw the market pull back on the S&P to about 3,600 in June, and then the next pullback only took us down to about 3,900, and then perhaps the next pullback that we see may only take us back down to 4,000 or 4,100, we're starting to see a pattern where the market will be starting to move from the lower, the lower left to the top right, and the peaks and valleys will see some nice peaks, but the valleys or the declines won't be as great. And that's when you start to see a channel going the other way. So a bit of technical talk there, but the bottom line is this: if we don't start to see, or if we can start to see, I should say, let's think positively, less of a decline going forward. So the declines are a little bit less and less as we move forward. I think that is a catalyst and a spark for this market. And I think individual investors should take notice of this. If the lows are not as pronounced and less deep, less sharp, I think this is a signal to the market, signal to investors, and we could see investors coming in and buy this market again. So let's look to see if a lot of these interest rate increases are starting to be baked in to what the market is doing. Lastly, oil. And interesting, I was talking to somebody recently, and we have a chart of oil to show you the price of oil, how much price of oil is falling. And obviously all the sanctions that have been placed on Russia, you can see how much oil has fallen down to about $88 a barrel. The Russians obviously cannot sell oil, or not selling oil anymore, to the West, or selling very little of it. So who are they selling to? Well, they're selling to India, places like China. And that's been a positive for Russia and the price of oil in general. But recently, China has gone into a fairly large lockdown. They've locked down a number of cities, a number of people again. And what this has done is diminished the demand side for the price for oil in general. So if I think it's something like 300 million people are being locked down in China, the demand for oil and energy products would be less. So what does that mean? Well, that means that the supply-demand equilibrium is starting to come more into shape, and the demand is now perhaps getting closer to what we have in supply. So we're seeing the price of oil fall because the demand for oil is falling. So in some funny way, even though China is buying oil from Russia, which is not helping with the overall inflationary situation in that way, we're actually seeing, because of their lockdowns, they're helping on the demand side, and we're starting to see the demand for oil fall, and that's why we're seeing the price of oil fall, which will help inflation going forward. So keep an eye on the price of oil. Will we see the price of oil spike as China stops their or removes their lockdowns? Will we see the price of oil spike as we get into the colder months, November, December, and into January? That will be key to keeping inflation down or stopping it from rising back to the highs that we saw early on. So for individual investors, again, keep your eye on the price of oil. For many individual investors, if you've been watching the business shows, whether it's BNN or in the US, CNBC or Bloomberg, you've been noticing they've been throwing around terms, central banks, soft landing, hard landing. Can the central banks negotiate or navigate this economy to have a soft landing, or will it have a hard landing? And I thought we'd talk a bit about this today, because it is so prevalent in some of the conversations that we're hearing on TV. So what is a soft landing or a hard landing? And the best way to explain that is, if you're on a plane and you're about to land on a runway, you obviously want to have a soft landing on that runway. You don't want to have a hard landing or come in really steep and have a really bash and crash kind of landing. So that's the same for the market. We're noticing that the market is falling, and we all know that over the first, let's call it 8 months of the year, we've seen negative numbers for the markets right across the globe. But as the central banks continue to raise rates, and at some point when they stop raising rates, or at least slow the pace of that rate increase, will the economy be able to get back on its feet? Will the stock market be able to turn around and begin to move higher quickly? Will they have a soft landing? Will they be able to bounce back in a soft landing situation? Or will the market have a hard landing? Will interest rates rise enough to take our economy, to take the US economy as an example, into a recession, a deeper recession, whereby we have a hard landing scenario where it takes the economy and the stock market a lot longer to rebound? So that's kind of what the terms mean. I'm still hopeful for a soft landing. I do believe that as interest rates continue to increase, it becomes more and more difficult to navigate or to create this soft landing scenario for central banks. And I think that's why the market has sold off as much as it has over the course of this year, because when you look at history, it's been very difficult when we look back at previous Federal Reserve governors and Federal Reserves and governors in general to negotiate or navigate to create this soft landing. We tend to see more of a hard landing situation. And as interest rates rise, I guess investors become more and more disillusioned and upset, thinking that a soft landing is probably not going to happen. And we may see the worst case scenario, or at least a worst case scenario, which is a harder landing where the economies, both Canada and the US, go into perhaps a deeper recession. I don't think that is the case. I believe we will see a bit of a soft landing. I think the US is already in a recession, but a very shallow one. It's possible that Canada could follow into a shallow recession, but I think it's going to be one where we bounce back very quickly. So I'm more in the camp of a soft landing. And again, we should continue to look for information coming out on this type of approach, whether we're leaning more towards soft or hard landings going forward into the future.